Hello everyone. In today's video, we will talk about the best reversal candlestick patterns, which indicate that the continuous downtrend will end and may reverse to an uptrend. A bullish candlestick pattern can be single or multiple candlestick patterns, but before we go ahead, the following should be noted. Bullish reversal patterns must form at the end of a downtrend, or else it will work just as a continuation pattern, and to know the end of the downtrend, one of the confirmation indicators must be used, such as the RSI indicator, volume, or any other indicator, and in order to master its use, we will give examples of these patterns and indicators. Number 1. Hammer. Hammer is a bullish reversal candlestick pattern that occurs at the bottom of a downtrend. This bullish candlestick pattern is formed when the open and low prices are almost the same. This pattern should consist of a lower shadow, which is twice as long as the real body. After knowing the simple information about the hammer candle, let's see this on the real chart. Here we notice a hammer candle at the end of the trend, and then we notice a slight rise in the price. Here too, the pin bar candle, which in some cases can be a hammer candle as well. And here is a hammer candle followed by a rise in the trend. As you can see, there are many successful examples of this type of candle. But not every hammer candle means bullish, sometimes the opposite may happen, and this candle will be a bearish candle, as you see here, and also here. And in this case, it is called a hangman candle. But the question is, how can we avoid this trap, and how can we identify the bullish hammer candle from the bearish candle? Simply, we will use one of the trend confirmation indicators, and the best indicator that can be used with this type of candle is the Bollinger Bands indicator. Regardless of the color of the candle, when we see that a large part of the body of the hammer candle is below the lower band, it means that we found a good indicator to enter into a long position. But when the hammer candle is green and its entire body is below the lower band, the signal will be stronger and the trend reversal will be more accurate. Here too, we notice a green hammer candle and a large part of its body was below the lower band, and the result is a good rise in the trend. Here we find a green hammer candle and its entire body below the lower band, and as we said, when the whole body is below the lower band, the signal is considered strong. Always try to know the hammer candle and don't be fooled by every candle that closes below the lower band, because it may not be the last. And if you want to know more about this powerful strategy, please tell me in the comments.
Hammer. Remember the hammer. The hammer rode you on your back.
Number 2. The piercing pattern. This pattern consists of two candles. The first candle is red and the second candle should be green. In this pattern, the trend should be downtrend, as the piercing pattern is a bullish reversal pattern, and the green bullish candle should close more than the midpoint of the previous red candle. And to clarify this pattern more, let's go back to the chart. As we said, this pattern always comes after a downtrend, as it is made of two candles. The first one is a bearish candle, and the second one is a bullish candle. The red bearish candle should have a large real body, and the second green candle should close above the middle of the real body of the first candle, and this means that it has exceeded 50% of the size of the red candle, and the result is a reversal of the trend. Here too, we can see the piercing pattern, a downtrend, followed by a green candle that crosses the middle of the last red candle, and we also notice a slight rise in the price immediately after this pattern. Even here, the pattern is considered the same, but the larger the lower wick size of the green candle, the weaker this pattern is estimated. Here also, we notice a big red candle, followed by a green candle that has crossed the middle of the red one, but here, there is no downtrend before it, so the reversal was very weak. This pattern is considered one of the powerful patterns, especially in quick speculation and future trades, because often, the price will rise immediately after the formation of this pattern, and this means we will not wait for the price to go down and re-rise again. But you must bear in mind that the percentage of profit is always small, but it is very guaranteed, and that is why it is used in future trading, more than in normal trading. And to increase the accuracy of this pattern, it is better to use it with the stochastic RSI indicator, as this indicator moves quickly between the oversold and overbought area. For example, here we notice that the stochastic indicator is moving in the oversold area, and at the same time, we notice the emergence of the piercing pattern. Here too, we notice a harmony in the signal when the stochastic indicator reached the oversold area and then bounced back to the top. This pattern appeared, and indeed, the result was great. Here, as we said, the pattern is weak, and even when you look at the stochastic indicator, you will find that it is very far from the oversold area. Number 3. Bullish Engulfing pattern. This pattern consists of two candles. The first candle is red and the second candle is green, which in turn completely engulfs the body of the previous red candle. That is, if we move the red candle inside the green, it will be completely swallowed up. The second thing, the red candle, and even its upper wick, should not be longer than the green candle that follows it. But the truth may be a little different. In the theory we will find it like this, but when we see it on the real chart, we may find it like this. And since we have a free chart as well, let's take advantage of this opportunity and look for these candles. Here we notice that this pattern, as the theory told us, and indeed, after the formation of this pattern, we find a rise in the price. Here too, we notice a large green candle that has engulfed a red small candle after a downtrend. Its shape may be slightly different from the first one, but the most important thing is that the same conditions have also been applied to this pattern. The downtrend and a small red candle was swallowed up by a large green candle, so the conditions are the same, with a different shape. Here too, we find that the shape of this pattern is different. As long as the body of the red candle has been swallowed up, there is no need to worry about the lower wick, because all that matters is the body and the upper wick. Even here, we find that the shape of this pattern differs from the shapes before it, but as we said, the conditions remain the same. Here we find a downtrend that ended with a small red candle, which was swallowed up by a large green candle, but with all this, there was no reversal, and the price went down. So, as we said, we must use one of the indicators to confirm the oversold and overbought areas. And with this pattern, we can say that the best indicator is the RSI indicator. Here, for example, at this pattern, we find that the RSI indicator did not cross the 50 line, and even the yellow moving average line, it's still far from it, and did not cross it. And in this case, the pattern signal will be inactive, and we will not use it. Here, the pattern gives the signal of the continuation of the uptrend, and also a crossover signal in the RSI indicator. Here too, the pattern appears, and the RSI indicator is confirmed. Well, engulfing pattern signals are strong and reliable signals, whether in a trend reversal, or in confirming the continuation of an uptrend. But what about this pattern here? Is it a bullish engulfing pattern? No, this is wrong. As soon as you see that the upper wick of the red candle is longer than the green candle, then know that this pattern is normal candles that are not distinguished at all. Number 4, the 3 white soldiers. This pattern is considered one of the best bullish patterns, especially when used on large frames, as it is rare due to some complex conditions to find it, but when you find it, it will be a valuable gem to enter into long positions. This pattern consists of 3 bullish candlesticks, which are green in color and do not have long shadows. The first condition for finding this pattern is to use the relative strength index, or in short, the RSI indicator. The second condition is that the RSI indicator must be at the oversold area, which is the black area here, or as it is called, the 30 area. The third condition, we must see that the RSI indicator has returned to the purple area after it crossed the 30 line, and after these conditions are completed, we should see 3 consecutive green candles, not containing long shadows, and each candle should close higher than the one before it. Here too, we find that the RSI has reached the dark area here, and after going back up to the purple area, we notice that there are 3 green soldiers as well. And as expected, the price has also gone up. Here too, the RSI is in the oversold area, and we also find 3 green candles, but due to the small size of the third candle, the pattern may change to another deliberation candlestick pattern, and the results may not be good. Well, you may not always find this pattern, but when you do find it, try to take advantage of this opportunity as much as possible. Number 5, the morning star. The morning star is a triple bullish candlestick pattern that indicates a bullish reversal. As it is formed at the end of a downtrend, it gives a warning sign that the downtrend is going to reverse at any moment. It consists of 3 candles. The first is a bearish candle, the second one can be either bullish or bearish, with a small body, and the third candlestick is a bullish candle. In theory, you will never find this pattern because the truth may be in many forms. You may find it like this, or maybe like this. You may find a doji candle in the middle, or you may find an inverted hammer candle, or a small hammer. The shapes always differ, but the basis remains the same. Let's go back to the chart to see this naturally and away from graphic theories. It is recommended to use any indicator to determine the bearish trend first, and in this example, we will use the moving average indicator, and it will be EMA 24 and EMA 12. When we see that the candles are moving below the EMA lines, this is considered the downtrend, and we will look for the morning star pattern. Here we find a red candle, followed by a green retracement candle, and the third candle is a large green candle, so this is the pattern we are looking for. The entry in this pattern is above the body of the longest candle, whether it is the green or red candle. Also the target candle must be above the EMA lines. Here also we find the same pattern with a difference in the shape of the second candle, and the last green candle has crossed the middle of the first red candle. So the entry will be the same way, above the level of the longest candle, and above the EMA lines. Here also the same pattern has appeared at the end of the downtrend, a red candle, followed by a small candle, and finally, a green candle that crossed the middle of the first red candle, so, the same thing, we will enter above it. This area seems devoid of this pattern, but let's look further. Here we may think that this is also the morning star pattern, but it is not, since the middle candle's shadow has crossed over the first candle. This means that this pattern is wrong. I hope you liked the video, but do not forget to tell me about the best pattern you liked so that we can explain it in detail and test it with one of the successful strategies. Finally, thanks for watching, and don't forget to subscribe. Good luck.